Thanks for joining me this Wednesday, the 19th of February. I'm Grady, market analyst for Bell Direct, and this is our midweek reporting season coverage for week 3 of this February 2025 reporting season. This video will digest the results and investor reactions to BlueScope Steel, A2 Milk Company, LendLease and BHP. So far, it still appears so good this reporting season, with a vast array of companies defying the odds to post double-digit earnings growth, despite strong headwinds of inflationary pressures, elevated costs and subdued demand across most sectors. To date this February, 57 companies have reported, with 21 beating expectations, 19 meeting expectations and 17 missing expectations. A miss this earnings season didn't deter investors from buying into Australia's largest steel producer, BlueScope Steel, on Monday though, with shares in the company rallying almost 13% following the release of H1 results. For the half, BlueScope reported a 57% decline in underlying EBIT to $309 million, but expects H2 earnings to be in the range of $360 million to $430 million in H2, signalling earnings growth of at least 16.5% on the lower end of that scale range. NPAT for H1 also fell 59% to $179 million, and net cash outflow was reported at $21 million. It appears investors were more focused on the upbeat outlook for H2 though, as steel prices have risen 20% in the US since President Donald Trump took office, which is a region BlueScope Steel generates around 45% of its earnings in. Infant milk producer and dairy producer A2 Milk Company soared over 19% this week on the release of an impressive first half results, including the declaration of an inaugural dividend of 8.5 New Zealand cents per share. Double-digit earnings growth headlined A2M results as revenue rose 10.1% to $893.8 million New Zealand dollars. EBITDA margin came in at 13.3%, down just 0.6 basis points due to supply constraints. NPAT rose 7.6% to $91.7 million New Zealand dollars, and the company had a closing net cash balance of $1.014 billion. Sales in China and other Asia regions grew 11.8%, which is a rebound on recovery and demand there, while US sales rose 13.3%. Recent challenges around demand out of China facing the milk company seem to be easing though, as A2M upgraded both revenue and EBITDA margin guidance for the remainder of FY25, with the expectations of low to mid double-digit revenue growth and EBITDA margin slightly up year on year. In a tough building environment during 1H25, or the first half of FY25, LendLease managed to post soaring operating profits of $122 million thanks to a recent strategy shift since May 2024 to focus on capital recycling and operational simplification. Statutory profit after tax rose to $48 million though during the first half, a significant turnaround from the $136 million loss reported in the prior corresponding period. The sale of the company's UK construction business was announced since the implementation of the new strategy, which investors welcomed as this division of the business slipped into the red in H1, with results out indicating a loss of $25 million for this division in the first half alone. Cost management has been mixed for LendLease in the first half, with corporate costs down 61% on the PCP, while net debt increased to $3.8 billion over the first half due to transaction delays. On the outlook front, LendLease has a strong pipeline of new development opportunities in the Australian market. Loss-making projects will largely be complete during the second half of 2025, and capital recycling transactions to the value of $2.2 billion have been completed or announced to date. And of course, Australia's iron ore giant BHP reported first half results signalling tough operating conditions amid a depreciated iron ore demand environment and price environment throughout the first half of the financial year. Australia's number one trade partner, China, had depleted demand, and this weighed on the results out of BHP this week. For the first half, BHP reported revenue down 8% to $25.2 billion due to primarily lower iron ore prices and steel-making coal prices, which were partly offset by a higher realised copper price, of which BHP is expanding its operations in quite aggressively. EBITDA was in line with consensus expectations of $12.4 billion, an 11% decline on the PCP, while underlying attributable profit came in at $5.1 billion, down 23% on the prior corresponding period or PCP. But profit from operations rose 90% to $9.1 billion. Net debt was an area of significant growth for BHP, with an increase to $11.8 billion from $9.1 billion. And BHP's capex rose 10% to $8.3 billion US. The biggest shortfall for investors in this report, though, was a 30% reduction in the interim dividend to 50 US cents per share, but this still beat market consensus estimates by 1 cent per share, or they're expecting 49 cents per share. On an outlook front, BHP reported eased inflation pressures are being realised, but tight cost pressures on a labour front are expected to remain in H2. Demand is expected to recover, with India emerging as a bright spot for commodity demand, and production output guidance remains unchanged for FY25. With commodity prices expected to recover in H2 across the board for steel and iron ore, BHP may feel some relief in the results out for the full year later this year. Elsewhere in the market, we had results out of Baby Bunting that showed slight growth on the prior corresponding period and a return to profitability for the infant retailer. Judo Bank rallied almost 10% this week after lifting margin guidance to the upper end of the range previously stated, and Challenger shares tumbled despite the investment management company reporting a 12% increase in net profit to $225 million. Later this week, we will cover the results out of Fortescue, James Hardie Industries, Goodman Group, Rio Tinto, Telstra Corp, Wesfarmers, and many more. We hope you enjoyed this reporting season coverage video, and be sure to subscribe to our Bell Direct YouTube channel to stay up to date and ahead of the market with all news, market insights, reporting season coverage, and of course, exclusive interviews.